You know, we have been trained to live our lives with blinders on because they'd much rather you see the lie than the truth. So we got to talk about what's happening in the gold and silver markets because I'd rather you take those blinders off and make educated choices that, I don't know, what a concept, puts your best interest first. Because, you know, the price that people see is largely created by the flow of funds. We've talked about this. All of this money that's been pushed into the system, and it's a trading market. Ooh, there's a new shiny thing. Let's go over here. Oh, there's the next shiny thing. Let's go over here. So it's really about the flow of funds. But frankly, it's really leveraged and intangible claims. Intangible, not the real thing. Intangible, you can't hold it. Those claims can multiply, and they do, much, much faster than the physical metal because that's a button push and creating the appearance of abundance. Oh, there's so much gold and silver out there, but they're moving prices for reasons completely unrelated to physical demand. And yet the system increasingly requires more debt, more liquidity to maintain that confidence and appearance of stability. Those claims can multiply so much faster than the physical metal because that's a button push and based on all of this debt creation that they're making. But the appearance of abundance and moving prices are for reasons completely unrelated to physical demand. Yet the system increasingly requires debt and liquidity to maintain that confidence and stability. Truthfully, that additional debt weakens the currency and it increases gold's monetary importance, and silver too, as an asset that is outside of the debt system. That's what we're really looking at here. And as physical inventories tighten and real users demand the metal, guess what? What we've been seeing for roughly a year and a half now is supply and demand dynamics that are beginning to exert more and more power over prices. Is this the last hurrah in the paper markets? I don't think so, but it's a possibility. We'll find out. Because that's why direct physical ownership belongs as the foundation beneath every other form of exposure. What if I'm right? What if I'm wrong? How about doing something that it doesn't matter whether you're right or wrong? What a concept. Because here's the real question that everybody's asking. Why are gold and silver falling when the reasons to own them are growing? So let's begin with the mystery. Obviously, wars continue in Eastern Europe and clearly in the Middle East and more places. Debt is rising. Governments are borrowing more, which means they're expanding the money supply and creating more inflation, which is proving sticky. Shocking. Central banks are buying gold at the highest levels ever. And silver is needed in more and more parts of the modern economy to build out these data centers, etc. And frankly, confidence in government, in the currency, in the system, it's being sorely tested. And those should all be reasons for gold and silver to rise. What's going on? Yet suddenly the prices can fall, sometimes pretty violently. So what is the market really trying to tell us? Have the reasons to own gold and silver disappeared? No. Has physical demand collapsed? No. Or is the price on the screen measuring something very different from what most people believe it's measuring? Because what looks like weakness in the metal may actually be stress somewhere else in the system. And frankly, once you understand what the screen price is really showing you, those declines become far less frightening. You don't see me frightened of them, do you? And frankly, the only reason why I pay attention to them at all is because you pay attention to them, and I need to be your guide through this. So today, we are going beneath that price to replace confusion and fear with, I don't know, what a concept, understanding and educated choices. After giving up our right to convert dollars into gold in 1933, in 1974, Americans were about to regain the legal right to own physical gold again. U.S. officials asked London gold dealers what they expected to happen when that was lifted, when that ban was lifted. And their answer, remarkably revealing. They expected a large gold futures market, a paper and intangible market to develop. That's what they were going to push. They expected the physical holding of gold to become relatively small compared with contract trading. And that's what's happened. And they believed that the volatility created by those future contracts could discourage long-term physical ownership, because they don't want you and me to think about gold as money, which I do. This is money. They want you to think about this garbage as money. Well, it ain't money. It's currency. Think about that. Before the market fully developed, insiders already understood how it could change public behavior. So instead of asking, how many ounces do I own? People would increasingly ask, what did the price do today? The focus would shift from ownership to price movement, which falls right in with their plan. From wealth preservation to trading and the financialization of every single asset on the planet. That means it's just turned into a financial product, and it's about trading. But I believe physical possession is critical. And then you want financial exposure? Rock and roll hoochie coo. From physical possession to financial exposure to a trade, from ownership to a trade. It does not require a single secret meeting or one master plan, but it tells us that the effect of the system, it was understood. And a large contract market could become more visible than the physical metal itself. But was that the only prediction? Or can we actually see what happened? I don't know. Once gold became both a physical monetary asset and a heavily traded financial instrument. Let's look closely at what changed after 1974. This is the purchasing power versus the spot gold contract. Now that white line is the purchasing power of fiat currency. Over time, well, it keeps falling because they keep doing this kind of thing. That gold line is the visible dollar price of this fixed price of gold when it was fully and totally a monetary asset. Over the long term, gold moved dramatically higher as the currency bought less and less and less. But the journey was anything but smooth because these are contracts. So we'll see the surges in there and we'll also see the collapses. We'll see these contracts recover, move sideways, and then surge again. So there are two things that were happening at the same time. The long-term direction reflected the weakening purchasing power of the currency. Even though it's a contract, look at that, it still certainly does that. But the short-term path was increasingly influenced by trading flows, leverage, liquidity, and emotion. A fund may sell gold because it needs cash. A trader may sell because a model changed direction. A bank may reduce exposure because its risk limits tightened. None of those actions means the dollar suddenly became sound. And the dollar, by the way, is currency. It's not money. None of them creates another ounce of physical gold. And yet, they can still move the visible price. So I really do want you to understand that the price and the monetary value are not always telling you the same story. The price may be telling us what leveraged traders are doing today. The monetary value tells us why gold has endured across centuries through so many currency resets, over 4,800. And that is hopeful, because a volatile price does not mean the asset has lost its purpose. It simply means that we have been watching the wrong signal. What a concept. So how did financial trading become powerful enough to dominate what the whole world sees as the gold price? The answer is hidden in something the physical market cannot do. But you see, the financial market, that can multiply. This chart shows the enormous growth of precious metals derivatives just in the FDIC insured banks since 2001. This is from the Office of the Comptroller of the Currency. I show you this regularly. And while I cannot tell you the exact leverage used, can you see how a surge in buying or selling contracts could influence that contract price? Can you see that? Because that's not the physical, but at the exact numbers. But those exact numbers are far less important than the structural change. Because frankly, a physical ounce of gold's got to be mined, it's got to be processed, refined, transported, stored. And someone who owns it must be willing to sell it. Are the central banks selling their gold? Only if they need to survive. That's a whole big point of gold, isn't it? But a financial claim can be created with the opening of a contract. That's it. Ba-bam! All sorts of new gold now exists. And exposure can expand without another ounce being produced. And this leverage allows a relatively small amount of capital to control a much larger position. We've talked about this so much. But that means that the contract market can create emotions and enormous flows of buying and selling. See that perception management? And because the market with the greatest volume often produces the marginal price, those flows can dominate the numbers we see on the screen. So the screen may look like it's measuring physical supply and demand. No. But in the short term, it is really only measuring the movement of leveraged money. Ooh, there's the next shiny object. Ooh, there's the next shiny object. Claims can multiply. Metal, not so easily. This is the difference between financial liquidity and physical supply. And those two areas will be clashing. I can't tell you when, but I know that they will be clashing. Because financial liquidity can appear limitless. Doesn't it appear limitless? I mean, what is the limit of that? None. But it still sounds theoretical. So let us make the leverage visible. Because how much contractual gold is outstanding compared with the unpledged register metal beneath it? Here you go. Here's the contrast. These are outstanding, just the COMEX gold contracts represented approximately 38.37 million ounces compared with approximately 12.92 million ounces of unpledged registered gold. That means that could be delivered out. Nearly 3 contractual ounces for every unpledged registered ounce. Now, look, a lot of you are going to say, what about the world debt clock and showing all of those, all of that leveraged? And oh yeah, by the way, what about the Bank for International Settlements showing 62,000 ounces for every 1 ounce of physical that exists? This stuff is so hidden. So I'm showing you something extraordinarily conservative. But now I want to be even more precise, because this is not a prediction that every contract holder will demand delivery tomorrow, since most contracts are closed and it's just about rolling them over and capturing any gains in this crap, right? But that's the hidden assumption. The system does not need 1 ounce immediately available behind every contractual ounce. That's fractional reserve lending. It needs most people to remain satisfied with the claim. It needs you to remain satisfied with the claim. Do you get that? Additionally, leverage creates the appearance of supply without creating any more metal. More contracts are not more gold. More liquidity, more money flowing into the system is not more gold or silver. A deeper market in claims does not make the underlying physical asset less finite. And once you see that, a falling contract price is no longer automatically proving that physical gold has become unwanted. It may simply show that financial claims are being sold, whether it's margin calls or any other reason. A new shiny object over here, it doesn't matter, because now the mystery becomes even more interesting, frankly. Because while the claims remain large, what's been happening to the physical gold underneath them? You can see that the physical inventory rose sharply, but then from the peak, the direction changed, didn't it? Inventory began moving lower. Registered gold is associated with delivery warrants. That means you can deliver them out. But eligible gold meets exchange standards, but it's the owner has not necessarily made it available for delivery, so they can't sell it. Neither category means every ounce is freely offered for sale. Understand that. If there's a run, yeah, they got a big problem. But the trend matters because the financial claims remain large while the physical inventory has fallen from its peak and look, continues to fall. And that doesn't mean that the system must fail tomorrow. It means that the cushion underneath it is smaller, and it makes the behavior of physical owners that much more important. They don't want you to take physical possession of the gold, because when you do that, you're outside of the system. But the market, that contract market, well, that gives a price quote. Woohoo! But it cannot force a physical owner to surrender metal at that price. And eventually, every price needs a willing seller. And when there is a run on the system, like there was prior to 1933 and 1929, remember that bank run, right? Claims exceeded available supply of gold, so they had to take it away from the people. That happened again in the 60s with foreign governments wanting to convert their dollars into gold. But we didn't have enough gold to satisfy all those claims, so we took gold away from the world. This same thing is happening again, and that's what I'm showing you. But those contracts can hide everything. So really, why should the availability of physical gold matter so much? Because gold is not merely another commodity sitting in a warehouse. It's the monetary anchor beneath an enormous mountain of users and promises. All the gold ever mined would form a surprisingly small cube that physical stock supports. is an extraordinary number of users. Central banks hold a reserve, governments hold a strategic asset, financial institutions use it, investors use it, industry uses, technology, consumers. Gold sits at the intersection of money, wealth, trust, and scarcity. That is why I call gold the world's anchor. A contract can reference gold. A derivative can track gold. A token can claim to represent gold. But none of them can perform the full monetary role of physical gold unless the metal is actually there and legally available to the future owner. The physical asset is finite. The claims built around it are not. And the more promises the financial world creates, the more important that anchor beneath those promises become. This is not rocket science, it's just logic. Gold reveals the monetary structure. And if I had one wish, it would be for everybody to start thinking about gold and silver as money again, and this stuff just as currency. That's all it is. But silver, it adds something gold does not face to the same degree, because silver is not only held, it's consumed. It is consumed. And that may make the silver pressure point where the financial and the physical markets collide first, because silver, it's the fuse. Here we see the same basic structure in silver as we did in gold. A large financial market exists above a limited pool of physical metal. But silver faces an added strain because its inventory, well, it's also fallen from higher levels. And unlike gold, much of the silver purchased by industry does not simply move from one vault to another. It gets used up. It goes into electronics, vehicles, energy systems, medical equipment, communications, defense, and on and on and on and on and on. A trader can roll a silver contract into another month. A manufacturer can't always roll a production requirement. At some point, the factory needs the physical silver, and a financial claim cannot be soldered into a circuit. It cannot conduct electricity. It cannot complete a solar panel. The physical metal must appear, period. That is why silver may be more than gold's volatile younger cousin. Silver may be the fuse that exposes the limits of financial abundance. Look at the number of users competing for a much smaller pool of mined silver. Silver serves the monetary world, the industrial world, the technology, medical, energy, and defense. It is being pulled in many directions at the same time. The financial system can create additional silver exposure almost instantly. But the new mine supply takes years. And projects require capital, permits, energy, labor, infrastructure, and refining capacity. That creates a very important difference. In a financial market, price can be pushed by the flow of funds. In the physical world, price is eventually disciplined by availability. If a real user cannot obtain silver at the quoted price, the quoted price is not the whole truth. We have seen premiums in both gold and silver all around the world. And that means that the buyer begins to ask a different question. What price will actually secure the metal? The spot price becomes irrelevant, doesn't it? And that may be where real supply and demand begins taking back more influence from those leverage contracts. Not in one dramatic moment, but gradually through premiums like we've been seeing, delivery demand like I've been showing you, inventory withdrawals, and owners refusing to sell too cheaply. That is not a message of helplessness and loss of demand. It is a reminder that the physical world still has the final vote. Yet just as these physical pressures are becoming more visible, the system is offering investors another way to move farther away from possession. They don't want you to hold it. You hold it and own it. That runs no counterparty risk. But the next substitution does not arrive as a warning. It arrives as convenience. Look at the color of the tokenized gold. Physical is the same color as gold ETFs, like it's their equal. None of those are equal. None of them. Tokenized gold is not automatically the problem. A properly structured real-world asset, we got to see, but it may represent allocated physical gold and provide some legal ownership rights that allow the holder the freedom to redeem the token for the underlying metal. But it's still a claim, and it still requires somebody else living up to the promises. That can make tokenization a bridge between digital liquidity and physical ownership. But the word gold still does not answer every question just because it's tokenized gold or digital gold or anything else that they want you to think. There is no substitute for holding the real thing in your hand. Because the question is the specific metal allocated to the holder? Does the holder have direct or beneficial legal title? We've talked about beneficial ownership. Is the gold independently verified? Can the holder actually take physical possession? And what are the minimum redemption amounts, fees, identity requirements, and geographic restrictions? And by the way, can the same issuer, custodian, or platform delay or suspend redemption? Some tokenized products offer a genuine path to possession, maybe. Others may provide only economic exposure, which is what all that other Wall Street garbage does. So the real issue is not whether the asset is digital. The issue is whether the digital claim leads to metal or whether that path remains available when you need it the most. A token may represent ownership, but until the metal is in your possession, access still depends on the structure performing as promised. And that raises the larger question. Why is the financial system creating so many new ways to hold claims on assets? I don't know. Maybe because the system depends on liquidity, and whenever that liquidity becomes unstable like it is now, its answer is almost always more debt. This chart compares the expansion of central bank assets with financial markets. When markets become unstable, authorities respond. They create liquidity. They expand balance sheets, lower rates, support credit, encourage borrowing. Those actions may help stabilize financial markets, and they may prevent an immediate collapse and even make the system appear healthy again. But the support is not free. It adds debt, it multiplies currency, it devalues the currency, and adds more financial promises. And every new promise increases the importance of an asset that does not support someone else's liability or promise. That's the stability paradox. And I need to point out to you that when they changed the rules in 2022, as you can see on this chart, after a minute, something major happened. There was a pattern shift. And those parallels no longer hold. And this is what puts everything in jeopardy. And why you see what's going on in these markets today and the level of volatility, down 20%, up 10%. I mean, this is not investing. This is gambling. But look at this chart and look at it carefully and look at where those paths crossed, because you are looking at support from central banks declining, and yet markets, remember I said we're in melt-up phase? Nothing matters to those markets. All of the money that they created in the system is still sloshing around. That makes having this and this in your possession that much more important. The system just use more debt to preserve confidence in a debt-based system. But the more debt it creates, the more valuable the idea of debt-free money becomes, which is exactly what physical gold and silver in your possession are. Not necessarily in tomorrow morning's screen price. You're not going to see it there. Wall Street's not going to give you good price discovery. But in monetary importance, in the need for your protection, in the need for that anchor. The debt used to stabilize financial markets increases gold's monetary importance. And the attempt to preserve the financial structure strengthens the reason to own something outside of that structure. This is what's happening. This is a huge warning sign. And once you see that paradox, well, doesn't the whole mystery change? The system's apparent solution might actually be creating the need for, I don't know, think about this, a different kind of safety. The system's solution to instability, the need for money outside the debt system, take a look at what the global central banks are doing. They are buying gold and continue in 2026 to buy the highest level of gold ever. Why? Why? Because they want to retain their freedom. Same reason why you should be doing the same thing. The deeper realization is that when the system becomes unstable, it does not usually reduce the promises. It creates even more promises. More debt, more liquidity, more financial claims that can support those new, higher, overvalued prices. I mean, nobody's even arguing how overvalued these markets are. It can delay consequences. It can make things look however they need it to look for you because you're being fooled by their lies. It can create the appearance of stability, but it cannot restore purchasing power that's already lost. It cannot help you see the truth. Take off those glasses. See the truth. It cannot turn debt into money that carries no counterparty risk. This is not money. This is debt currency. This is money. This is money. This is the only money. According to the Bank for International Settlements, gold held at home is the only financial asset that runs zero counterparty risk. And guess what? These markets cannot turn debt into physical gold or silver. That is where hope enters the story, because everybody's working on hopium, and we are not powerless. We do not have to predict the exact day the system changes. We do not have to win every trade. We don't have to win any trades. We do not have to outsmart the largest banks or the fastest adopters or algorithms. We only have to understand the difference between the layers. Because a price can be managed, a market can be leveraged, and a claim can be multiplied. But physical ownership, it's physical ownership. And that brings us to the answer. Not rejecting every financial asset. I mean, we know that this is where I've lived my life, and I don't own any of that other stuff, but I'm not saying you shouldn't, because you need to do whatever it is that you're comfortable. But not hiding in the future, preparing it, putting things in the correct order. If the stability paradox sounds theoretical, look at what the institutions closest to the monetary system are doing. Because central banks, well, they are buying gold at the highest level ever. And that matters because central banks understand the system from the inside. They're the ones that are doing it. They're managing the reserves. They're reporting crises and creating them and responding to them. They expand those balance sheets when financial markets become unstable, the lender of last resort. And yet, while they use debt and liquidity to support the system, they're also increasing their ownership of physical gold. Why? Gold does not depend on another government's promise or anybody else's. It is not someone else's liability. It cannot be created with a policy announcement, and it cannot be printed to solve a funding problem. That is why it forces fiscal responsibility. Central banks are not buying gold because they expect it to move smoothly every day or use it as a trade. They're buying it because physical gold provides a foundation beneath a system built on debt and promises. I'm going to repeat that because I really want you to get that piece. Central banks are buying gold because physical gold provides a foundation beneath a system that's built on debt and promises. That's the important distinction. They use currency to operate the system, but they hold gold to protect against the risks within that system. And notice what they're buying. Not futures contracts or ETFs, and certainly not a token. Physical gold held as a reserve asset. Don't you think that tells us something? The institutions that understand monetary risk most directly are rebuilding the physical foundation beneath their financial exposure. That's not a message of fear. It's a message of preparation. They are not waiting for the system to fail before they act. They're strengthening the foundation while the system is still functioning. And they started that in 2005. And that brings us to the deepest realization in this entire story. The system's solution to instability strengthens the need for money outside the debt system. That is why I talk about physical gold and silver as a foundation, not a trade or a speculation, a foundation. At the base is direct ownership. Direct ownership. You hold it, you own it outright. Physical gold, physical silver. No margin calls or expiration date or forced rollover or anything like that. No broker who can liquidate the position because collateral requirements changed, and no requirement that a fund, clearinghouse, or digital platform remain willing and able to perform. Now, above that is the price discovery and trading layer. Spot, futures contracts, those markets all serve a purpose, but their exposure to price, not possession of the asset. Above that may sit those financial opportunities. I do not believe in them, but rock and roll hoochie coo. ETFs, mining stocks, royalty companies, the latest and greatest, they may offer liquidity, income growth, or leverage, at least for a minute. Though truthfully, it's only in this stuff. And if the value of this stuff is zero, like my $10 trillion Zimbabwe note, what do they really offer you? But quite honestly, exposure and performance, that's not ownership. and it's not protection. Physical gold and physical silver are not safe because their quoted price can never fall. They provide a different kind of safety. Safety from forced liquidation, from expiration, from devaluation, from counterparty dependency. This stuff, it's counterparty dependency. Safety from relying entirely on a system whose answer to every crisis is even more debt. At Zang International, we work only with physical gold and silver to build that foundation. But because our role is to help people build that ownership layer first, that's the foundation that should be and needs to be beneath every other form of exposure. And that's the hope. That really is the hope, my hope, to get sound money back in the global monetary system again, so we cannot be abused by all of these lies. Because what gold and silver really do is they reveal the truth. The screen price does not mean anything. It's a trading price, and it does not have to control your understanding. And I'm hopeful that this has helped you take these glasses off, because volatility should not be controlling your decisions, and traders that are just looking for a little bit of a pickup in this garbage, because that's not what we're about. And the financial system does not have to be the only place where your wealth exists. And in fact, it should not be the only place where your wealth exists. Because if it does, and they say no, they take away those promises. Promises can be broken. What do? You need to have something real, something finite, something that has the broadest base of functionality and demand and is above all governments and central banks' ability to inflate away. Something that does not depend on another promise to pay. If this raises questions about your own foundation, our strategy specialists are here to help you build that sound money strategy centered on physical ownership. That's what we do, and it's based upon your goals. Because claims can multiply, and so can debt. But gold and silver, physical in your possession, that doesn't multiply. It does, however, go to fundamental value when all confidence is lost. And it does put you in a position to sustain your current standard of living and to expand your wealth base so that as that wealth transfers, I don't know, what a concept, it transfers your way for a change. But how about we come together to get sound money back in the system so that the guys that created this mess and took control of everything, let's take control back. I know we can do that. And until next we meet, please be safe out there. Bye-bye.